Hi, and welcome to our first Building Pulse of 2025. We are catching up again with Cameron Bagrie. We haven't heard from him this year yet, and we want to see what he's got to say, both on our local economy, obviously, but also what the impacts of a Trump president and tariffs and things like that are going to be. So we'll go ahead and bring him into that. I have been talking for a while about some of the changes we're going to be making, particularly to high performer building and the building pulse. So hang in there with us. We're looking at about a March, April launch of a relaunch of what we're doing with Building Pulse. It's pretty exciting. So thanks for joining us so far, and we'll look forward to what this year's got in store for it. Let's go ahead and bring Cameron in and get the latest on the economy. I guess, what are your views on the kind of the pace and the sustainability of New Zealand's recovery, given the recession and then the easing of the monetary policies and where we're at now?
Right. So the seeds of an economic recovery are being sown.
Yep.
So if you look at a lot of the high frequency, most recent data, and these includes the various business confidence survey, they basically tell us we've got a little bit of forward propulsion back. Yep. Yeah, we're in recession, the June, September quarter of last year. It was dark times, but we've sort of turned the corner. But I guess the analogy I'd sort of use is that we're probably crawling along the bottom of the bathtub. You know, it's pretty anemic where we sit at the moment. The earnings guidance coming out of New Zealand's listed companies and how they did in the December quarter have been pretty lukewarm. Yep. So we've sort of stopped the rot. We're expecting momentum to build over 2025 as those interest rate sensitive sectors, construction, housing in particular, retailing, get the benefit of lower interest rates, because there's about 73% of mortgages are going to refix in the coming 12 months.
Right.
So people have played the interest rate hedging card actually pretty well. We're going to see an economic revival. The big issue that you alluded to is what's going to be the quality of it. And the quality is not going to be driven by what the Reserve Bank does with their magic wand and lifting interest rates. They can get demand up. But the issue is the supply side capacity, the ability to meet demand. The availability of labour resources, how well we're investing in capital, plant, machinery, and also the productivity of it. Now the Reserve Bank's chief economist came out last week and said New Zealand's what's called potential growth, how fast we can grow conceptually from year to year, doesn't look that flash.
Yeah.
So what does that sort of mean? It doesn't look like we're going to see a real big upturn. Like normally you go through a screamer of a downturn, you pencil in a real strong V-shaped recovery out the other side.
Yeah.
It just doesn't look or feel like we're going to see that this time around.
Yep. And that's what I suppose in some ways that can be helpful, right? Because the volatility of that normal cycle can be more harm than good in a lot of ways. But I guess my question is, what are the good sides and the bad sides of a slower recovery?
Well, the bad side of a slow recovery is you leave a lot of economic scarring. The unemployment rate remains a little bit persistently high.
Right.
If you don't have confidence to invest because you're in slow growth mode, that sort of hits you 5 years down the track.
Yeah.
The glass half full story of what we're starting to see at the moment is that when you see the likes of the Reserve Bank's chief economist, and the New Zealand Treasury came out within their half-yearly economic and fiscal update, they're both saying we have a productivity problem. And if you've got a productivity problem, you've got a standard of living problem. So the 2025 budget is obviously going to be pretty strong on growth, productivity. The proof will be in the pudding in regard to what those initiatives actually need to be. But we can't just rely on the public sector, central government, to drive productivity growth. The private sector's got to do an awful lot of that heavy lifting as well.
How do you think the Reserve Bank is going in terms of balancing inflation versus fostering growth?
Well, they've got an inflation target, so forget about having a growth target. They don't have one.
Yeah.
Yeah. The sooner or the easier they hit their inflation target, the quicker they can take interest rates down towards what's called neutral, where they've now got the foot on the accelerator or the brake, and that number's around 3%.
Right.
Right. So it looks like they're going to cut another 50 basis points at the next meeting. I think they'll go a little bit slower after that.
Yeah.
But inflation's in the low twos. Yeah,
So
core
when
inflation
we
is still a
talked
little
about,
bit higher.
yeah, when we've talked about inflation in the past, the kind of I forget the terms, mate, because it's not my forte, but the internal inflation was still sticky and high around 5 versus the overseas inflation was bringing it right down.
Yeah, so that's what's called tradable versus non-tradable.
That's right.
All right, so we've got tradable deflation, and we've still got pretty stubborn non-tradable, which is your domestic stuff.
Yeah.
Now,
what is that sitting at?
4.5.
Right. So that's, and really we want that down in that 1 to 3%.
Yeah, you sort of got to get that number down towards 3.
Yeah.
So if we have a look at your interest sensitive parts of non-tradable inflation, i.e. construction costs, they've flattened out.
Yeah.
Yeah, because you just can't pass on price increases in a low demand environment. But the other side of it is that things like medical insurance, plus 20, local authority rates, plus 10.
Yeah.
They just add a little bit of stickiness to that. But your non-tradable trend is lower. And that's given the Reserve Bank a bit of confidence that, when the official cash rate was 5.25, 5.5, you're a long way away from 3.
Yeah.
And monetary policy works with a lag. So you can't wait to hit 2 before you start taking it back to 3.
Yeah.
And what the Reserve Bank is doing at the moment is that they're just taking steps to get it closer to that neutral rate, because they think they're on target to have inflation there or thereabouts, your core inflation, all this sort of stuff, in that low 2 for the next couple of years.
Yeah. So, and what are the risks of a deflation for that tradable rate? Like, I mean, we don't have that much control over it anyway, right? But does that mean we actually maybe need to stomach a little bit higher non-tradable so that it's balancing out?
Well, that's typically what we've done for 30 to 40 years.
Yeah.
Is that 30 years? We've relied, tradable inflation is typically averaged 1% per year.
Yes.
Non-tradable is averaged slightly in excess of 3.
Right.
We've, generally speaking, outside of COVID times, we've got to 2.
Yeah.
The big issue at the moment, or one of the big issues, is what's going to be the average for tradable inflation going forward. And that's a function of the New Zealand dollar in the near term, oil prices, but also supply chains, and what's going to happen to tariff policy around the globe.
Yeah.
Right. The world is going through a deglobalization process. Yeah. Is that going to add more into the cost structure? So maybe tradable inflation is going to be a little bit higher. That means non-tradable probably needs to be a little bit lower than the historical average. So we're still sort of navigating our way at the moment in regard to where these things are going to sit. And as we've seen in the past, couple of days in regard to trade policy, it's all over the place.
Yeah. So explain for us, what are some of these big things that Trump is doing? What are the impacts it's likely to have on the US economy, and therefore what are the impacts it's going to have on our economy, and time back to this piece around this tradable inflation?
Right. So if we go back and have a look at putting tariffs on things is absolutely nuts.
Yeah.
Right. Because the consumers pay at the end of the day. What we've seen in the past couple of days is that trade policy or tariffs have been used as an economic weapon.
Yes.
Right, to get concessions. And that is unfortunately a reflection of the economic environment we sit in now, which is where the rules-based system we've been used to, countries played nice and fair, is now becoming a power-based system. So Trump got his concessions out of the Canadians, and he's got his concessions out of Mexico.
Yeah.
But it sets a pretty nasty, scene in regard to where we could be going forward, because if big countries can get away with it, odds are they're going to use that as a bit of a weapon going forward. And New Zealand likes an environment where barriers are low, not where barriers are high, because we're an export-orientated nation.
Yeah. So to me, then that means what we would do as a country is start looking at other markets, and we don't want to rely heavily on the US market, so we start investing heavily into developing markets elsewhere. That then has an impact on the US. Do they care? Well, they care. Does Trump care? Not sure. But New Zealand doesn't have a lot to barter with. We kind of just have to ride the waves, right?
Yeah, well, if you think about New Zealand, we're the two-bit player at the international roulette table.
Yeah.
Right? Let's have if you think about what's happened in America, where power has trumped rules, we're seeing some of the same stuff between New Zealand and Australia. And if you want an example of that, the 501s. You have them.
Yeah.
And that's turned out to be an economic problem for us as well as a social problem.
Yeah.
It makes absolutely no sense what they've been doing. But power trumps rules. So it's fine if you're a big country. It's not so great if you're a smaller country. Yeah. And we're seeing the world as increasingly fragmented into different trading blocks.
Is there examples of this in history in terms of this kind of dynamic playing out, and then what has been the response? Is this the situations where the small countries start banding together and trading as groups, or what are the options here?
Well, we saw a bit of this in the 1920s.
Yeah.
We also saw some really good stuff in the 1920s in regard to the era of industrialization, that sort of stuff.
Yeah.
And what we're seeing at the moment is probably a parallel, and the negative parallel is that the world is deglobalizing. We're splitting off into trading blocks. The positive parallel is that AI is the 1920s equivalent of industrialization.
I can say that.
Yeah,
but ironically, AI is naturally global.
Yep.
It's borderless.
Well, yes and no. Because there's a battle royale at the moment on another trade theme. We talk about power trumping rules.
Yes.
There's another big theme out there at the moment that's been around for a while, is that there is now a security overlay in trading. And it's security in regard to food, energy, and technology.
Yeah.
So the United States is increasingly restricting, what microchips is going to be available to certain countries. And it's not just America that's doing it, because the chips control the computers and the computers control the machines. And it all comes back to technology.
So what are our options? If you're sitting here and you could pull some levers, what would you be looking to do in New Zealand right now?
Well, some of the stuff we're doing on the international trade front is really good, trying to pick off new markets.
Yeah.
But I think there's some existing markets that we've probably been a little bit lax on for too long. I think there's a lot more we can do in regard to markets such as Japan. There's the broader Asian region as well. Obviously we'd like to get India, but India's going to be a long road ahead, we suspect. We've actually done pretty well in regard to America.
Yeah.
There's been a huge diversion trade where the red meat we used to send into China is now our biggest red meat export market now is the United States.
Right.
The United States is growing importance for wine, that sort of stuff. But we've just got to get out there on the global stage.
Yeah.
Right? And the previous government was not out there on the global stage.
Yeah.
So the Prime Minister at all is reasserting New Zealand and getting in front of people. But it's a delicate balancing act when you think about two of our biggest markets are the United States and China.
Yeah.
And Lord knows where that's going to go.
So, and then what about, so with tariffs in the States, That's a drop in demand for some of our product. We can go look for other markets. Is it somewhat offset or helped by the weakening of the Kiwi dollar?
Yeah, so that becomes a buffer.
Yeah.
Yeah, but New Zealand doesn't exactly produce widgets that you can store.
Yeah.
Yeah, we produce food.
Yeah.
Right, so it's got to go. You got to find a market.
Yeah, interesting.
But that New Zealand dollar is acting as a pretty important crutch.
How strongly do you believe that the housing market is no longer in its typical 10-year cycle? And what does it then look like?
Right, so if we look at the typical 10-year cycle, the typical 10-year cycle was sort of split into, you know, a 7-2-1 split. You know, sort of 7 years it goes pretty well. 2 years it's sort of flattening out, and 1 year it's awful.
Yeah.
But you double every 10 years.
Yeah.
And if you look at the maths on what that was, house prices would typically grow at 7.3% every year. Right, and you get that doubling effect. The problem was that incomes grow up 5.
Right.
So if house prices are growing at an average over 30 years at 7.3, and your income's growing at 5, you end up in that unaffordability zone.
Yeah.
And what we've seen is that obviously house prices have come down a lot in the past couple of years. They're now flattened out.
Yes.
But if you look at house prices relative to incomes, they're not cheap.
Yeah.
Right. So your valuations don't look as attractive as what they've done at the start of a previous cycle.
Yes.
And that's one of the reasons I don't think the housing market is going to go gangbusters, because even though house prices have dropped, depending on the region, 15, 16, 17%, they're not in that cheap valuation zone.
No.
And we're not seeing residential property investors come back to the market.
Yeah.
And they're not coming back to the market because it's hard to make the numbers stack up. Because you're not getting a 5 to 6% yield.
Yeah.
Which is where interest rates are. You've got to pay your rates, you've got to pay your insurance, and they're both rising at double-digit rates. So to drive a bit of price tension in the market, you've either got to get a big inflow of people, which we're not seeing. You've got to see interest rates go down a real long way, and they're heading down. We can debate a real long way. You've got to see the valuation cycle that's looking favourable, and the valuation cycle doesn't look like it's favourable at the moment in level terms. And you've got to see the property investors return to the market, and none of those are in place at the moment. So the property market will pick up over 2025, but we're talking low single-digit rises as opposed to that 5 to 10% zone, in my view.
So am I right in that the housing market's a bit of a secondary market? It gets knocked around as a result of things happening in the other spaces. Is that correct?
Oh, it's both primary and secondary.
Yeah.
It's primary because it's New Zealand's biggest asset class.
Yeah.
Right? And interest rates don't remain stable. Right. So you tweak that interest rate switch by 100 to 200 basis points, it has a pretty immediate flow through to debt servicing costs.
Yeah.
Which flows through to retail spending, etc., etc., etc. It's secondary to a degree, or it should be secondary to a degree, because we've probably got too many eggs in that housing basket.
Oh yeah. Yeah. So what would be the drivers then for government to encourage increased migration?
Top one. The top one is to actually stem the departures.
Yeah.
Right. I don't think we have too much of a problem getting the people to come into the country. It's stopping the people leaving. And you can't stop people leaving.
No.
It's almost like it's within New Zealand's DNA to go do that OE.
Yeah.
There's always going to be that with people in their early 20s, that sort of stuff. But it's when you get permanent underperformance that you've got a problem. So Reserve Bank's chief economist, Paul Conway, within his speech, he said, look, New Zealand, GDP per capita used to be 95% of the OECD average. It's now 90%. Now GDP per capita is like a proxy for incomes.
Yeah.
So we've lost 5% of our income relative to the average OECD country.
Right.
Right. So if you're young at the moment and you're thinking, I want to get ahead, you're overseas.
Where does Aussie sit on that same measure?
Where Aussie would be slightly above 100% because we're about 10 to 15% below Australia.
Wow. Yeah. I mean, that's a challenge. So part of that's got to be seeing a more positive outlook. I think probably part of what's gone on has been a few hard yards for the last 5 years. And normally, when you're talking about that 7-2-1 cycle, you're going through hard times, not for 5 years. Now, ironically, the economy's had a big boost post-COVID, but then albeit with fake money, I guess. But that's, I suppose, potentially what are we seeing is if 5 years is too long for people to wait to start seeing the light at the end of the tunnel, and they're giving up and going elsewhere.
Yeah, well, the issue is, where else do you go?
But then what we've just talked about, it looks for us, it's a hell of a lot greener over the ditch.
Yeah, but there's also switching that can take place within your economy. So like when construction costs are really elevated and high, you tend to see a bit of switching away from building towards buying existing.
Yeah.
Yeah, now, because building costs, the figures show that it's flattened out. I think that's probably over exaggerating what's going on. I think there's a lot more discounting that's coming through and availability of work. So if you can get a new deal, you're likely to build new as opposed to buy existing. But we're still early in that cycle. It's almost like we're in a transition phase where we're going, where the market, people are sort of looking at it and thinking, well, interest rates are coming down. Historically, that's told me to buy, and historically, house prices double every 10 years. The problem is the maths on that doesn't stack up anymore. We need so if we assume that household incomes grow at 4.5 to 5%, and you sort of want valuations to normalise a little bit, the ideal for house prices will be something slightly below 4.5 to 5. So that the new normal might be 3.5 to 4% per year.
Yeah.
So you slowly bring the market back into some sort of realignment, as opposed to have house prices needing to go consistently lower year after year, because that will just destabilise your economic system.
Yeah. So what structural changes do you think that we need to make from a policy settings perspective? What would be helpful to do right now?
If you want an illustration as to how far things are out of whack across New Zealand, just drive around the roads.
Yep.
And, New Zealand's infrastructure is not just poor, but how we manage it is poor.
Yes.
So we build stuff, we mismanage it, and then we've got to rebuild it again. The capital productivity has been pretty well consistently negative for 30 years. So infrastructure you've got to have a look at. Your education you've got to have a look at, but education's a slow burner.
Yes.
You can't turn that dial overnight. You've got to release your regulatory burden, so it's just easier to get stuff done. We've got to be opening the doors to foreign investment and making it easier to get those deals done. There's a smorgasbord of stuff that can be done. You've got to get R&D settings right. I think we need to have a look at our tax system as well. It's just a question of time. It'll be interesting to see whether capital gains tax features as an election issue. The health system, I think, is going to be a big election issue in 2024. 26. So what's the space on that one?
Yeah. And so the other thing that we kind of have talked around a lot, but I suppose more directly in terms of productivity, it's always been an issue for New Zealand. Well, no, it's not true, but for a long time it's been an issue. Something that's very easy to talk about. We need increased productivity. But how do you actually, I mean, those mega things you're talking about, it makes a difference, infrastructure, education, but they're all slow burn. And maybe there is no short answer, but what are the things that we need to be doing for any short-term gains in productivity?
I think New Zealand's technology uptake, AI, is notoriously slow.
Yes.
The OECD, within the Economic Survey of New Zealand in 2022, referred to poor management practices, particularly in regard to technology, embracing artificial intelligence. The underperformance of the New Zealand Stock Exchange compared to global peers, even if you strip out the Magnificent Seven and all those other sort of catchy names we've got for the tech companies, New Zealand market has been a big underperformer. And we tend to focus on releasing capital through dividends, as opposed to value stocks and real value creation over time. So there needs to be a mindset shift.
I was going to say that. Yeah.
And how do you bring in that mindset sort of shift? It's almost like in New Zealand, globally, productivity growth has slowed everywhere, right? And there's been various reasons presented as to why that's taking place, because we're all internationally connected, but it's been particularly pronounced in New Zealand.
Yes.
And we can't keep on blaming the tyranny of distance, because that's a one-off level shift. In New Zealand's labour productivity growth is 0.2% per year on average for the past decade.
Yeah.
It used to be 1.4. We've got to get that number up. We've got to get it up quickly, because otherwise this economic recovery that we're penciling in is going to be a bit of a damp squid. It almost feels like the New Zealand economy is like the population. We're all getting closer to retirement. And we're thinking about, I just want to take a deep breath and just relax.
Yes.
And how do we get that entrepreneurial spirit, that preparedness to take risk, have a crack back into New Zealand? Because I think we've lost that over the past sort of 10 to 20 years.
Well, don't you think as well this is a byproduct of us investing so heavily in property? Because I mean the catch of it is it's worked bloody well for a lot of people, right? But it was the safest investment, and you really, as a nation, you got really rewarded for not taking risk and buying property because it's the safest thing, and you really did get rewarded, but there was it was very low risk. And do you think that has had an impact on our greater risk appetite, and particularly given that it's we're not looking at the productivity or the performance or anything of property. All we're looking at is the valuation going up and just continuing to sell stuff to each other, essentially, like it's not producing anything. And so we haven't learnt to look at those kind of outputs.
Well, it's been the easiest game in town. And it's worked. So why look at something else when something's worked for 30 years? So we've got a whole industry out there around property. And if you look at the banking sector has progressively screwed the scrum more and more towards property, particularly residential. And part of that, they've been economically incentivized to do so because they need to hold more capital. What's the low risk weighted item? It's housing. So write a housing loan as opposed to a business loan. So there's a whole lot of these sort of things that have led us to where we are. The issue at the moment is, how bold are we prepared to be to rewrite the playbook?
Yep.
And but it's all about getting real entrepreneurial spirit back into your economy. Preparedness to have a crack and take a bit of risk.
Do you know what the split is? Because I think you touch on something interesting in terms of the aging population, and that's an effect, right? What is the split in terms of generationally where the capital is held percentage-wise? And obviously there's, it's going to be pretty obvious, and there's some trends that are going to be there, for centuries just because of life cycles. But has it shifted? Are we seeing a shift in terms of percentage of wealth and capital held at those later stages of life from what we saw historically?
Yeah, I can't remember the numbers off the top of my head, but just if you look at the portion of the population that's aged 65 plus, that's now more than 1/5 the population.
Yeah.
So just by the very definition, the fact that you tend to get wealthier as you get older.
Yeah.
Right. And then you tend to release a bit of capital. It's called the life cycle hypothesis. As you're 65 plus, you save through your working life, and then you either redistribute the money to family or you just bequeath them when you're going to visit the Almighty up above, that sort of stuff. We're starting to see a lot more of wealth transfer taking place within those cohorts, to get family members
more than usual, more than historically, you mean?
Yeah, but it's just as you get more people within a certain cohort, you're going to have the proportion of wealth tied up in that cohort is going to be a lot larger. And I just can't remember the numbers off the top of my head. I didn't use them in a presentation 6 months ago, but the amount of wealth tied up in the 65 plus group was absolutely phenomenal.
Yeah.
It's a huge chunk of cash.
Because arguably, 35, 40 to that 50, 55 bracket is probably the bracket that's prepared to take a bit more risk. They've got some wisdom, they've got some capital behind them, and they've got enough years in the tank to still take some risk. Is that accurate? And B, does that then mean we want to figure out how to get some of that capital back into that sector?
Yeah, well, there's a big constraint on that sector. Constraint number one, let's just say you buy your first house in your late 20s or your early 30s.
Yes.
You're not going to have a low mortgage.
No.
Right. So you're going to have to go like hell far more than what your parents had to in regard to paying down that mortgage, and odds are it's going to be over a longer time frame.
Yeah.
All right. Secondly, we're having children later in life.
Yep.
All right. So now it's you could be you'll have teenagers still at school in your 40s.
Yes. Yeah.
And so normally you'd see people progressively saving a lot more in that 40 sort of plus bracket, but the ability to score that money away, build a bit of a capital base, is really eroded when you've got really high property prices relative to income.
Yeah.
And this is not just one income. This is household income.
Yeah.
Because quite often now you've got both house members are out there working.
Yeah, that shift that we had back in the late 90s, early 2000s, where we tipped over from needing one income to two incomes to buy a house, essentially. It's kind of like a one-trick pony. Once you've done it, you can't go back. So in some ways, what it did was it increased the serviceability of the market all of a sudden. So then there was more borrowing, and that probably fueled house prices again. But you only get to do that once, and then it stabilizes, and now you're back where you were. But everyone's just working a hell of a lot harder.
Yeah, well, you come back to the basic maths. If house prices are going up an average of in excess of 7% per year, and your income's going up at 4.5 to 5,
yeah,
eventually you get a valuation constraint.
Yeah.
But it's not just a valuation constraint, it becomes a societal constraint because you end up with rising wealth inequality across your economy. And when you've got wealth inequality, you can bet your bottom dollar that's going to turn political.
Yeah.
Because why does that person, get on the property ladder and that person sort of can't?
Yeah.
Yeah, and I wonder whether the debate on capital gains tax and whether it's a pure one or not, we can sort of debate. But I suspect that debate is going to come back.
I mean, I think there's an opportunity at the moment that won't hang around for too long for the right, someone on the right side, to jump in and control the narrative from a different perspective and have a conversation around capital gains that is, perhaps a bit more from a long-term investment perspective in the economy as opposed to a rights situation.
Yeah, well, let's just look at the basic maths of the fiscal position at the moment. The government this year is going to run a deficit $15 to $17 billion. Biggest deficit outside of the main COVID year.
Yeah.
And now the projections are that we're going to get back to surplus if we effectively cut a whole lot of government services.
Yeah.
All right, and that's population adjusted, adjusted for inflation, that sort of stuff. I think we're going to struggle to do that. So there is going to have to be a debate across this economy on how much tax are we prepared to pay. And it's not just to return to surplus, it's to manage the fiscal cost of an aging population. Because that number is now, we're spending what, 25 billion odd on New Zealand superannuation.
Yeah.
It's an awful big sort of chunk, and should it be the entitlement that it is? Or should it be a lot more targeted?
I think the shame is the locking of the age, right? And I get that it's frustration. It's the same frustrating thing that I have around KiwiSaver, and why I'd rather have it somewhere else, because I don't want a government dictating to me down the track when and how I can have my money. But super is a bit different to that. But I think when we were talking before around UK, you've got people buying houses later, having kids later, all of that shifting, but also we're living longer. So arguably the whole thing needs to shift, and we might need to adjust our expectation for how long we're going to be working. But yet that 65 number has just been so bloody sticky that we're really paying for that now.
Yeah, well, when the 65 number came out, we were living a little bit beyond 70.
Yeah.
Right, now we're living in excess of 80, and you're 85, 86 for females, and that number keeps going up.
Yeah.
So your 65 is not the old 65. To be fair, 65 can be the old 65 for some people in society that got certain jobs.
Yes. Yeah.
Right, and that's part of the. There could be an inequity in raising the retirement age for everyone, because everyone doesn't have the same job. Everybody doesn't have the same ethnicity, and your population, or life expectancy is different by ethnicity. And that's for a variety of reasons. Part of it is looking after yourself, but part of it is the nature of work that people do on average.
Is there an argument to lose super altogether? When does that end up happening?
Well, I guess the big issue in late 2025, the Treasury is going to have to come out what's called their statement on the long-term fiscal position.
Yes.
It comes out every, I think it's 4 years. It's an update of where we're going to be 40 years out in regard to the fiscal position. And every time that report's come out for the past sort of 30 years, it basically says the status quo is not sustainable. So the 2021 report said on current policy settings, and because demographics are a big driver of health expenditure in New Zealand superannuation, and you got more elderly driving that expenditure, smaller growth in the workforce. If left unchecked, net debt will go to 180% of GDP. Now, that was telling us we needed to do something. Have we done anything? No. The issue is that when do we wake up and realise, or when those projections, and they're only projections, right? When do they look so bad that someone's prepared to say we cannot continue with the status quo, and the earlier we move, the less aggressively we're going to have to move.
Yeah.
I can remember, was it 1999 that Winston Peters put a proposal down on the table where the government would provide a tax cut, and that would basically effectively go into a quasi KiwiSaver scheme. Yep. And depending on what your balance was at retirement was dependent upon how much your New Zealand superannuation got abated away.
Right.
But yeah, it got rejected by 90% of the population because it turned very political.
Mm. So how do we compare to the rest of the countries? Is everyone else facing similar problems, or are there some shining examples of where it's being done well?
Most countries, are facing the same problems. And if you look at New Zealand's superannuation expenditure as a share of GDP, we're actually slightly below, a lot of the European countries.
Mm.
But the problem here is not just New Zealand's superannuation. The big bomb here is health. Because as the population ages, and it's happening across the Western world, it just costs more to sustain an elderly population. Because, we're living longer. There's a lot more drugs, a lot more medicines out there. What's the space? And this is where your Indonesias and your Indias, which have got a lot more faster growing populations of the younger generation, are the new epicenters of growth going forward.
I suspect in those countries too, they don't invest as much in healthcare in their elderly. They let their elderly die.
Yeah, well, there's a lot more emphasis on self-provision and families.
Yeah. Thanks for joining us. And like I say, we appreciate you being a part of this journey. We're really excited about what we're doing this year. There's going to be some shifts and some real input into this space. So thanks for being part of that. And yeah, stay with us and stay tuned. Cheers.